So if I had $1 every time somebody asked me whether or not they needed to pay estimated income taxes, I would probably be retired. And I think the reason for that is that most people start their journeys working for someone. And when you work for somebody, they automatically withhold the taxes that you owe based on a W form that you provide to your employer. So you're a W-2 employee. But as a day trader or somebody that's self-employed or somebody that's an investor, you're generating your money based off of the work that you're putting in. And when you do that, you're required to pay taxes quarterly. Now, the reason for that is it makes it easier to pay these quarterly so that way you don't have a big lump sum payment come tax time in April. So in today's video, we're gonna take a little bit deeper dive into estimated income tax. Let's go. Hey, what's going on, everybody? Brian Rivera here, CPA. And on this channel, I talk about a lot of different topics: personal finance, entrepreneurship, investing, all that good stuff. But my main goal here is to spread the love, spread the knowledge, and help you save some money along the way. So if you are brand new, don't forget to hit that subscribe button. Paying taxes is extremely important because it allows you to satisfy the potential tax liabilities that you might have based on the income that you incur. Now, it's also important to stay ahead of estimated income taxes because this is also going to help you avoid any penalties associated with underpaying your taxes. So understanding those consequences will allow you to stay on the right side to avoid any mishaps or any surprises from our friend Uncle Sam. Estimated taxes are simply quarterly payments that you're going to send to the government to cover your expected tax liability. Now, the IRS's requirements at the federal level is that if you owe at least $1,000 during the year, or you expect to owe 90% of your tax liability, they will be expecting you to pay estimated income tax. So if you fall into that bucket and you owe estimated taxes, there are gonna be 4 periods of where these payments are going to be due. So the first period is due April 15th. The second period is going to be June 15th. The third period, September 15th, and the fourth period is gonna be January 15th of the following year. So if you followed an estimated tax payment schedule, you should be finished with your tax liability, or at least paying your tax liability, by January 15th. When you go to file your taxes by April, if you're not on an extension, or October if you are on an extension, when you go to actually finalize your tax return, if you pay too much in estimates, you should get a refund. And if you didn't pay enough, then you should be able to true up that liability, but it won't be as painful because you chipped away at it each quarter. So how do you know how much money to pay? So if you use a CPA or a tax accountant, obviously they can provide you with that information. The IRS has a worksheet that if you want to use that, I'll drop a link below in the show notes where you can access that. And also there's software applications out there that can also assist with projecting your tax liability, but it's all based on the inputs and you interpreting that information correctly. So there's gonna be several factors that are gonna go into this calculation, but generally speaking, you'll need to identify your income, your deductions, and any tax credits that you might qualify for to come up with an accurate calculation. So it's also worth noting that if you work for somebody or you have an employer, more likely than not, they are already withholding the taxes for you, so you don't have to go through this exercise. This is gonna be for anybody who is an investor, you have a business, you're a day trader, you generate some type of income where somebody's not directly giving it to you, but you actually have to get out there and get it. So let's walk through an example. So the first step is you want to identify what your effective tax rate is. And this is very simple. I know it sounds fancy, but it's very simple. And the first thing you want to do is you want to look at your prior year tax return, and you're looking for 2 key amounts, and that's going to be on your personal tax return or your 1040. One is going to be, what is your taxable income? This is not adjusted gross income, this is taxable income. And you also want to identify the total tax that you paid. Let's say your total taxes that you paid for the year was $16,500 and you generated $100,000 in taxable income, then 16.5% would be your effective tax rate. The second step now is you want to be able to identify what your taxable income is for that particular quarter. So if you remember earlier, we mentioned that you pay taxes over 4 quarters. So we're only identifying income that happens in 1 quarter. So the first quarter is due April 15th, and that's going to be income that is generated from January to March 31st. So we're only looking at 3 months of data. So let's say you're trying to pay your Q1 estimated taxes. You're going to need to add up all of your taxable income that is not subject to withholding. What that means is you don't have a W-2 job or you don't have an employer withholding taxes. So this is anything that's not subject to withholding. And then you also want to subtract the total expenses from that period, January 1st to March 31st. For example, let's say you work a full-time job and you make $10,000 in Q1 from your job. You have a side business that you made $25,000 in, and then your side business also had expenses of $10,000. So you would calculate the taxable income for estimated taxes purposes as follows. You're going to take B minus C, which is your side business income minus your side business expense. That's going to get you to $15,000. Your taxable income for this quarter is your profit for the period. So you could ignore your full-time income because you remember earlier, generally speaking, your W-2 job has withholding. Now, unless when you filled out your W-4, you put an insane amount of deductions or you told your employer not to withhold taxes, generally speaking, I see most people are covered from their employer. Now, the third step is you want to calculate the taxes owed. So the taxes owed is we're going to take your net income for that quarter, we're going to multiply that times the effective tax rate that we used from your prior year tax return. So in this example, if you made $15,000 during the quarter and you had a 16.5% effective tax rate in the prior year, you want to go ahead and send off $2,475. So you can repeat this same process for each quarterly payment. And also if you're subject to state income tax, you can do that for as well. So like I live in Florida, we don't have state income tax, but if you live in a state like New York, California, somewhere where you have state income tax, you will also have to do this exercise on the state income side. Now, just keep in mind, this is a very simplified version, but what I found, it works pretty well in just coming up with an estimate. You can always true that up at the end of the year, but right now we're just looking for estimate because we are paying estimated income tax. So now that we've identified how to calculate your estimated income taxes and how to pay your estimated income taxes, the only other thing that you need to be aware of is that there could be estimated tax penalty. So the good news is if you pay at least 90% of the prior year tax that you owe in the current year, then it is extremely hard to get penalized because you meet the threshold. So if your income is going to be significantly higher this year than the prior year, then it's a good idea, if you don't want to pay the complete amount for the current year during your estimates, you can use your prior year taxable income and pay 90% of that. All right, so late payment penalties are generally calculated using Form 2210, which is an IRS form, and I will drop a link to that form here in the show notes again. But generally speaking, the total underpayment for the year is gonna be multiplied times 0.03603, which adjusts every single year. So if you pay the tax you owe before April 15th, which is the due date of your income tax return, the IRS will reduce this penalty by a few basis points. But for the most accurate calculation, I would recommend relying on your accountant, your tax preparer, your CPA, and also you can use some off-the-shelf software solutions. All right, big picture. So now that we've identified your effective tax rate, how to calculate how much you could owe per quarter, I'm going to share with you what I see in practice. Primarily, I work with a ton of day traders and investors, and a lot of them have very volatile income. So what that means is one quarter you could make $100,000 and in the next quarter you could lose 100,000. So if you were following this model and in the first quarter, let's say you made 100 grand, you sent Uncle Sam 30K, now you're left with 70K to continue flipping or day trading with. Well, in the second quarter, if you get into a bad trade or you get into a bad flip, then you no longer have any capital to continue to use because you've effectively lost it. So in your mind, you're saying, okay, well, I paid estimates in the first quarter, but I lost all of it in the second quarter. So why did I pay it all in the first place? So generally speaking, what I see is most day traders take the underpayment penalty every single year. They almost view it as a margin interest loan, right? Because you are effectively borrowing the money that you owe Uncle Sam at their interest rate and deciding to pay it all at the end of the tax year. Basically, all you're doing is you're paying interest on the money that you owe Uncle Sam for the fact that you know that you can produce a better return on your money than actually paying it to them. Now, if you're someone who has a business that has predictable revenue streams, meaning day in and day out, you know what you're making on a monthly basis, on a quarterly basis. Even if you're a trader and you know you don't take big losses or your income is not very volatile, then this could be applicable to you. Then you should follow the quarterly estimated tax formula because that will help reduce a huge capital outlay come the end of the year. But for the people that have volatile income, I think it's probably better to keep that cash in your pocket. I'm just a messenger and I'm just giving you guys ideas. So hopefully you found value in today's video. So the last thing I'll say is, as a business owner, as a side hustler, as somebody who is on their own, it is easy to fall behind on this. So if you keep yourself up to date, you keep yourself educated, you will be on the track to success and you won't avoid any problems with Uncle Sam. So if you found value in today's video, don't forget to hit that like and subscribe button. Also, I'm currently running a free webinar that's gonna help you play defense on your taxes. And I'm gonna give you guys 3 strategies that are gonna help you save $30,000 or more on your taxes. You don't need to be a CPA. You don't need to be an accountant. This is just free knowledge. I'm gonna drop a link below. Feel free to check that out. Have a good one.